Sir,
Good sir.
Michael, how are you?
I'm doing great. Long time no see, my friend. What are we talking about today?
Well, for you, the viewers at home, my good friend Mike and I, today we're going to be taking you through the top 3 changes from Trump's new One Big Beautiful Bill and how they could save you $10,000 on taxes, your taxes this year. So I said 3. Did we talk about the 3? What are the 3 we're talking about?
Well, I guess we're cheating a little bit today because we're doing one. We're doing bonus depreciation. But the other one is killing two birds with one stone, and that's the SALT deduction, how that limitation has increased. And no, we're not talking about salt and pepper that you put in your food. You love salt.
Big salt guy.
And aren't your levels low? Never mind. This is an accounting podcast. We're not talking about.
No, but it's important for fitness and my athletes out there. If you're listening to this, you get it. You need salt. Stay hydrated.
There's actually some salt in my coffee right now.
Cinnamon too?
No cinnamon today. That's only in the fall. Fall is upon us, though. But the SALT deduction and that increase and how it impacts not only individuals, but also business owners. So we're kind of cheating there.
So that's our 2 and 3.
Yeah, that's 2 and 3.
So today we're going over 2.5 topics from Trump's Big Beautiful Bill. And if you stay around long enough, we'll throw in some extra sprinkles for you.
A grab bag of goodies, I guess.
More or less.
Yeah.
But before we dive into that, guys, we wouldn't be doing you justice if we didn't tell you who we are. So I'm Andrew D'Amico, CPA, partner here at Ledgerly, and co-founder alongside.
Oh, I'm doing it? Okay. Mike Abrahamian, CPA. Man, I'm not quick today. Also co-founder, partner, alongside my good friend Andrew. And we are repping some merch today. We got our Ledgerly hats on.
Yep, not for sale. I know mine's cooler. Appreciate it. Got the Flex Fit. We run Ledgerly, tax advisory firm, where we're focused on giving you guys tax saving strategies, helping you build better asset protection, and ultimately lay the foundation so you can build generational wealth. Generational in that it lasts, you can pass it on to your kids and your kids' kids, and the family just grows wealth over the years, long after you're gone and the name lives on. So that's what we're all about. And today we're just diving into, I don't want to say a small piece of the tax code because Trump's bill was the biggest change to the tax landscape since Trump's last tax bill, the Tax Cuts and Jobs Act from 2017. But enough nerding out on tax. Not enough. We're going to go deeper now.
Amen, brother. Let's rip it.
Yeah, so kicking off with bonus depreciation. So if you've heard it or if you've seen this on social media before, Trump brought back 100% bonus. What does that actually mean? So I want to take a couple steps back. And first, let's understand what depreciation is. Then we get into the 100% bonus depreciation and why that's important, because this year it was set to be 40% bonus. So let's unpack it. Depreciation, when you purchase something in your business, I'm talking to my business owners out there, whether you have a partnership, S corporation, even C corporation, whatever, you're self-employed. If you're buying equipment for your business, if it is over a certain dollar threshold or it's expected to provide use or help you generate income for longer than 1 year, you're not allowed to take that expense all in year one. So I buy, this microphone. Okay, maybe that's a bad example because I'm probably going to use it longer than a year, but it costs me $100, I think, for the set. Okay, it's not a big capital purchase. Now, if I buy a souped up desk, that's $1,000, $2,000. I'm expecting that to be around for 3, 4, 5, 6+ years, right? So what the IRS says is that you have to capitalize it. You cannot take the deduction for it in year one. I don't care if you spent $5,000 physically left your bank account. You cannot take a $5,000 deduction on your tax return. So that's depreciation in a nutshell. So why bonus is so important is it's actually a code under the IRS rules that allows you to accelerate that depreciation. So bonus was at 40% this year. What that means is that you can get a 40% deduction in year one instead of using, the IRS has all sorts of different depreciation tables, makers, straight line, and all these different rules and methods to depreciate. We're not going to nerd out on that too much. But with bonus, at 40%, you can elect up to 40% of that in year one. So on a $5,000 piece of equipment, 40% is $2,000. meaning instead of taking straight line and getting $1,000 of deduction in that first year, now you can get $2,000. And then we build on it a little bit further, 100% bonus depreciation. So now, when Trump reinstated this back to, I think his inauguration day, January 19th.
Yes, sir.
If you've purchased equipment in your business since January 19th that you were originally going to have to capitalize, now you can bonus depreciation 100%, get that full deduction on your tax return. So if you're especially in capital intensive businesses, you're buying pieces of equipment for $5,000, $10,000, $20,000. You can now deduct that entirely in year one. And it does. I know I'm kind of leaving you on the sideline here.
No, I'm soaking this up like a sponge. I got maybe some words of wisdom after you're done riffing.
All right, last piece. And the great part about this is you don't have to physically, you can finance these things. You don't have to physically dish out $20,000 for a piece of equipment. We had a small business owner. They bought $100,000. Honestly, I don't know what you call it. She's in the salon business. Shout out, you know who you are if you're watching this. But it was a $100,000 piece of equipment, and she got a loan for it. But can elect 100% bonus depreciation and get that deduction all in year one. So it's incredibly powerful, and you didn't have to spend $100,000 to get the deduction. So you're positive cash flowing, and you're reducing that tax bill massively. All right, I'm done riffing. Mike, what did I miss?
Man, I am jotting down some awesome stuff. So you said a freaking thing that I think is very important for business owners to understand. So let's rewind back. If possible, you could finance that piece of equipment, right? If you're buying a computer or a car or something that you don't have the cash on hand for, you can finance it. However, what Andrew and I do preach at Ledgerly is don't chase those deductions, because it's a deduction that's not going to be a dollar for dollar against your tax liability. It's only going to lower your taxable income.
That's a great point.
So we need to ask ourselves that question. Number one, do I need, not do I want it? You can't always get what you want. Okay, I'm just going to shut up now.
Stick to guitar.
Okay, yeah, I'll stop singing. Do you need it in your business?
Do you want it? Is it going to help you make more money?
Bang. And that's the second thing. Is this asset that I'm putting into service going to generate X amount of income? Here's my rule of thumb. And I told this to a client. We tell this to clients all the time. If you are financing a piece of equipment at a 5% interest rate, is this piece of equipment that you are financing going to generate revenue at least 5% more? Because you're paying 5% in interest. Is it going to increase your revenue at least 5%? If the answer is no, then maybe don't get into bed with that loan. So do you need it? Is it going to generate your income? Is it going to generate more income for you? Free cash flow. So not to be the glass is half empty guy, but trying to
it's important. It's important to know. So a few things to go off of that.
Yep.
So let's say crazy example again. $20,000. You want to buy this piece of equipment, and you're saying, "Oh, listen, Trump's on my side. He brought back 100% bonus depreciation. I'm going to reduce my tax bill $20,000." No. You're going to reduce your taxable income by $20,000. So if you are in a 20% tax bracket, 20% of $20,000 is $4,000. Did I get that right?
Say it one more time. I was shutting down, dude. I'm cooking over here. I got some awesome things to go off of this. You're rocking it.
I was just looking for you to say yes. You're great at math in your head.
Yes, you're great at math. Sorry, my human calculator.
So you get that would equate to a $4,000 tax savings. You got a $20,000 deduction, but at a 20% bracket, marginal tax bracket, that is how much you were saving in tax, that $4,000.
Right.
And I love that point that Mike also said, don't go chasing deductions. And you probably see, listen, everybody's on Instagram nowadays. I'm sure you've probably seen some influencers saying how you can write off, what are those big, nice cars?
Mercedes G-Wagon.
Yeah, the G-Wagon. That's what I was thinking of. They're saying, oh my God, this is how you can write off a G-Wagon in your business today. Like, okay, yes. So with cars, I mean, that's a whole nother monster, but they have to meet different rules in order to unlock full bonus on it. And there's a lot of limitations on bonus depreciation or even Section 179 depreciation, which is, again, a different beast, but another code that helps you accelerate depreciation.
Yep.
And now that I'm talking about that,
You're going to steal my thunder here, but you should just say it. Just say the common misconception between bonus and Section 179.
With bonus depreciation, it could actually take you into a loss. Whereas Section 179, on the face, they might seem like apples to apples. Whereas Section 179 is whatever, a section of the code that says, hey, you can elect 179, depreciate your equipment 100% in year one. Okay, cool. What they don't tell you, what you got to read in the fine print, is that it cannot take you into a loss.
Right.
Whereas bonus depreciation can. So that's why it's so big and why people are so jacked up and excited about that, because this is great for real estate professionals or people with short-term rentals or people doing self-rentals, because they have these massive assets with these buildings. They know how to implement a cost segregation study and accelerate depreciation on a massive basis. So they're actually generating losses, whereas 179 cannot take you into a loss.
Yeah, you're on fire. I just crossed off both of those. I was going to talk on them, but I love it, man. You're rocking it. But yes, the real estate portion is very important because it's not just business owners. It is also the real estate professionals, the people who are doing the short-term rental
Real
strategy.
estate is a business.
Yeah, exactly. Man, all right. Are you done? You done? Can I cook a little bit?
I'm sorry.
Still on the sink. No, but all seriousness, those are tremendous strategies, because on the face, you might just think that you have to be a operational business owner to take advantage of bonus depreciation. However, when you are active in the real estate game, like Andrew said, real estate is a business. You're filing a tax return with the real estate activity. You're showing income and expenses on the real estate activity. Real estate is a business. So kudos to that. I had one more point on the bonus side of things. And I think you've attested to it, maybe in another YouTube short or Instagram short. But it's also very important to know your industry. For example, Andrew and I, CPAs, we don't have a lot of overhead in our industry.
I did put this on a reel.
Yeah, and I was like, it's so freaking true. What do we need? A laptop, a desk, maybe a phone? There's not a lot of overhead, meaning we don't need too much equipment that needs to get capitalized. So there's going to be people out there that are maybe realtors or mortgage brokers or financial professionals that don't have a lot of capital overhead. They're also exempt from the QBI deduction if they're no, that's a topic for another time. But
Sure.
Or it's kind of like the people who, and that we're going to get to this, but the people who live in tax-free states. Andrew and I can say, oh, I want this bonus depreciation to benefit us. Do we really need it to? Unless we buy a laptop, yes, it will benefit us. But do we need that laptop?
We already got 3. We don't need a 4th.
Shh, don't tell the state that, or the town that. But in all seriousness, I guess the point that we're getting at is the industries that are really going to benefit from the bonus depreciation being back to 100% are people in construction, people that are maybe truck drivers, people that have a lot of overhead with buying things that are maybe helping them manufacture a product. Really more of that consumer good aspect rather than the service aspect. So it's very important to know your industry, and not all industries are going to benefit from bonus depreciation. So that's my story. I guess take it and run with it as you will.
No, that's great. I think we just hammered that to death, and pretty good. What do you guys think? Leave a comment below. Who did better on the bonus topic, me or Mike? But
the guy with no hair.
Hey, not the guy with the better hat.
I never said on the head or on the face.
Ambiguous. So let's keep this on the one big beautiful bill, because I would love to talk more about bonus and how it's beneficial to that real estate piece, but we alluded to it. We have other information on that. If you want to hear more about how to supplement this with real estate, get in touch with us. Drop us whatever we're on YouTube. Hit the subscribe button, drop us a follow on Instagram. We're constantly giving out free advice, but we're going to pivot here to number 2 on our list, the SALT deduction. So for those that aren't familiar, Mike, you care to brief the people?
Yeah. So the SALT deduction, how we said at the top of the podcast, the SALT is we're killing 2 birds with 1 stone here because it's going to benefit individuals and businesses. But let's take a massive step back. Let's go back to the drawing board like we're in preschool here. What does SALT stand for? SALT stands for state and local taxes. So our state taxes are like our income taxes. Andrew and I live in Connecticut. We pay Connecticut income tax. For those people who live in Florida or Texas, that piece is not going to be applicable to them because they have the benefit of not paying 5, 6, 7, 8% in state income tax. So that's the S in SALT. The LT, local taxes, that is your real estate taxes, your personal property taxes, your taxes on your home, your taxes on your car, your tangible goods that you're paying excess tax on. So that's what it really is. Income tax, local tax, you put those together and you get SALT. Now, back in 2017, under the original Tax Cuts and Jobs Act, the SALT deduction was limited to $10,000. And that $10,000 was for you people who itemize your deductions. For those who itemize, you know that medical can be a component in there, which we highly advise against. Use the HSA. Not going to get into it.
Plenty of videos on that.
Oh, yeah, we beat that topic to death. But what do we have? We got medical. We got interest on our home. We got our charitable contributions, charitable donations, and then we got the taxes. That tax piece was capped at $10,000 in 2017. Fast forward to Trump's new big beautiful bill, as Andrew alluded to. He's back, baby. Now he's really making a really big positive impact for us hardworking, tax-paying Americans. Instead of only being able to deduct $10,000 in taxes, SALT taxes, now we can deduct up to $40,000, which is freaking huge.
And I'll tell you from experience in us preparing tax returns for the past several years, you ask people, and we should back up further and even say, when we're talking about SALT and itemizing deductions, we're talking to individuals. This is for anyone filing an individual 1040. You can take the standard deduction or you can itemize your deductions on Schedule A. As tax preparers, we ask for all the information. Okay, is it going to make sense for them to itemize this year? Or should they just take the standard? I can't tell you how many forms we've prepared, get all the Schedule A information, and you see the state and local taxes, $15,000, $20,000, $25,000, $50,000, and all of them were capped at $10,000 because of the Tax Cuts and Jobs Act. So a lot of people were losing out on this because of that cap was so low on the past 7-8 years. But now that it's increased, now there's going to be a lot of people who are going to get that information and be like, oh no, they should be itemizing this year.
Yep.
So, and these are payments that you're going to have to make anyway. And you were just not receiving any deduction for it on your federal return over the past several years. So now with the increase, it's back. And again, there's still going to be people that are over $40,000, but at least, 4x from 10 to 40.
Yeah, absolutely. But now, and then I'm gonna cook with a couple of case studies here. But I do want to make a point on that. Those people that Andrew was saying that we're seeing like $50,000 in state and local taxes, and they're capped at 10. Those people are also making a lot of money. Those are high net worth income individuals. Now, full disclosure, there is a cap with the SALT, meaning that there is a phase out. So if you're making more than $500,000 in modified adjusted gross income, that $40,000 cap, it's going to be a dollar for dollar reduction. And if you're not single, if you're married filing separately, it's cut in half. So it's a $250,000 if you're over that AGI, modified adjusted gross income.
And their SALT deduction is only $20,000.
Would be only $20,000, correct?
For married filing separately.
Yes, because remember, for you married folks, if you're married filing separately, you both have to itemize, but your itemized is in half now. So you're only getting half the benefit.
Yeah, so one spouse can't take the standard deduction over here, and then on the separate return, the other spouse itemizes their deductions. The IRS says, no, you can't do that. If one itemizes, the other has to itemize.
Exactly. So let's run a couple case study scenarios. So we're going to do
Sure.
one for, let's just say the regular, I said regular, people are going to be pissed at this. Let's just say you only have a W-2 income.
The normies.
That's it. Which kind of props to you. You know, there's a lot of headaches with running a business. But anyways, you have W-2 income, okay? And let's say you were itemizing prior to Trump's original bill, and now with the $10,000 SALT cap, didn't make sense to itemize. You started taking the standard deduction. Now, maybe you went out, you bought a house. Maybe you have an interest rate on a home, and maybe itemizing is back on the table for you. The one thing to keep in mind is that your interest payments on your home are going to be the interest payments. Your property taxes on your home, that's going to be your property taxes. However, if you really want to max out taking advantage of the state side, the state income tax side, what you can do is have more withheld. I kind of feel like I'm going against the grain of how we usually teach, but more withheld by the state government. We're in Connecticut. Basically saying, hey, state of Connecticut, take a bigger piece of withholding by December 31st of the current tax year that we're in. Then on your W-2, you're going to have a larger amount that was paid in, which that larger amount is going to go on to Schedule A and get you closer to that $40,000 deduction. And then you would claim that refund back on the state side and also on the federal side because it's lowering your taxable income. All right, that was a lot of information I think I just threw at the people. Care to simplify that?
Yeah. So what he's saying is, I think it's good to highlight, it's not the state and local tax deduction, like he's saying, the state income tax, increasing your withholdings on your W-2 job. The deduction on Schedule A isn't based on whatever taxes you were assessed. It's about how much you paid. Right. Primary number of you, large amount of you are going to be on the cash basis of accounting. So if you paid out that cash during the year, you can claim that deduction. And like he said, if you're increasing your withholdings on the state side, you're probably going to end up in an overpayment. Depends on every situation. But if you jack up your withholdings, bigger deduction on the federal side, you're overpaid on the state side and you get that refund from the state. But you still got the benefit of the deduction over here on the federal side.
Right. Now, I guess another full disclosure is the following tax year, that refund is going to be taxable if you end up itemizing. So the refund that you got from the state of Connecticut is now going to be taxable on the federal side.
So catch-22, if you will.
It is. However, I want to know that I got a larger refund and then pay just my 22-24% tax bracket on the refund. Like, it's kind of a no-brainer because you're most likely going to end up saving money in the year that you're cash out of pocket than the money coming back to you and only having to pay whatever your marginal tax rate is, 15 weighted average percent is. So that is one thing to keep in mind, is that refund that you're getting back will be taxable when it comes back in the subsequent tax year. But then you have 12 months to plan for that. You have 12 months to plan for that extra income.
That's why you call Mike.
Who's Mike?
Sorry.
Oh, me? Oh, him.
When he doesn't answer you, then you talk to me, and I'll get a plan set for you for the next year, and hey, we're gonna plan for that refund that you're getting back.
But then you'll share the profits, right?
Oh, of course. I'll do all the work. I'll even edit this video. I'll get it out, look at it scheduled and everything.
Even when I'm in Greece, you'll do that for me?
Probably do it before you get to Greece. You could watch it from Greece.
Touche. I'll start getting clients from Greece.
Bring them back home.
Yeah, start doing some international tax work.
We already do one.
Or more. I think we do a few more. Maybe we should edit this part out.
You're right. No, it's good riff. Okay, so I also do want to disclose on, while we're talking about itemizing deductions, talking about the individuals. Now, listen, it still might make sense for you to take the standard deduction, because part of Trump's bill was maintaining the standard deduction as well as the income tax brackets where they are. So probably don't know this because it was 8 years ago, and I imagine if you're watching this, you're probably not a tax professional. Totally cool. But what he did as part of the Tax Cuts and Jobs Act was pretty much doubled the standard deduction, and that's what's offered to any taxpayer. It's just based on your filing status. Single taxpayers get, I don't know what the amount is. Is it like up to 15,000? It's between 12 and 15,000.
It's 15 something now. Yeah.
Yeah. So you rewind back to before the Tax Cuts and Jobs Act, it's probably closer to like $6,000 because it's also adjusted for inflation every year. The point being, when he brought that in 2017, 2018, pretty much doubled the standard deduction, and it was actually set to go away. Had this bill not passed, we were losing that all in either the end of this year or the beginning of next year. So standard deduction was going to be like $7,500 for single taxpayers.
Right.
So that's a big piece that we still get that higher standard deduction. So it might make sense to still take the standard if you don't own a home. If you aren't paying that much in personal property taxes, real estate taxes, again, if you don't own a home, there's no mortgage interest. So you need to do your due diligence. And that's why you get in touch with someone like a Ledgerly who can help walk you through this and plan for it before year end. Maybe we do want to increase your state withholdings to take advantage of this higher cap.
Amen, brother.
So that was number 2 on our list. But let's keep rolling with the SALT. I know you wanted to talk about this as it pertains to business
I guess
owners.
this technically is number 3, the business side of SALT, the salt to the pepper. Let's set the stage. So now let's say you're that individual and you're like, you know what? I like my W-2 income, but I'm sick of working for the man. So I'm going to go start a side hustle. And your side hustle ends up freaking blasting off. You're taking it to the moon and you are ready to go into business with someone as a partnership or take your LLC to the next level and convert to an S corporation. Now what there is in the table for how many states? Like 36?
I thought it was 35.
35. So
income tax states.
Now, again, full disclosure, do your due diligence, find out, number 1, you know what state you live in, so you know if you're paying income tax. And if you're a business owner, see if you have something called the pass-through entity tax, the PTET. We in Connecticut, we have that. So what the pass-through entity tax is it's a state tax that instead of being paid down here at the individual level,
at your 1040.
At your 1040, exactly, you pay it up here at the business level. And the business level is the S corporation or the partnership, essentially the flow-through entity. It's a flow-through entity because you're getting that K1 that comes through, right?
Flow through because the activity, even though it's on a separate tax return, the activity flows through from that 1065 or that 1120S, that business tax return up here. It flows through down here to the 1040, and that's where you pay the tax.
Exactly. Got clients calling. They must be seeing the video.
We live streaming?
We should be. Like, you're not correct. So let's get that example on the board, right? So you're the business owner, you're crushing it. Let's say you're netting $200,000 as an S corporation, let's call it. So you're an S corporation business owner. You live in a state where you can take advantage of the pass-through entity tax, and you're netting $200,000, around the end of the year. What you can do is pay in amount, pass-through entity tax amount, out of the business to your state. Let's call it $30,000. That $30,000 would be a federal tax deduction. So we have $200,000 less the $30,000 that you're paying in pass-through entity. Now you're only going to be federally taxed on $170,000. Sounds good to me so far, right? You're getting a federal tax deduction for that $30,000.
I think I'm on board, yeah.
The next piece. That $30,000 that you're paying to the state is going to flow down to you on your 1040, a pass-through entity tax credit, if you will. So, you know how on your W-2 for your state withholdings, how you might get a refund? This pass-through entity tax credit acts the same way. It's almost like W-2 withholdings, okay? So right now we got a federal tax deduction. We have a pass-through entity tax credit that you're going to claim on your individual level, your 1040 level. Number 3 is whatever your state taxes on your return at the business level, at your S corporation level, whatever that tax is, that's going to flow down onto Schedule A into your SALT deduction, into your $40,000 cap. So you're getting a federal tax deduction on the business, you're getting a credit at your personal level, and then you're getting another federal deduction on Schedule A on your 1040. And here's kind of the cream of the crop. Here's the cherry on top. That federal tax deduction that you got at the business level that brought you down from 200 to 170, that lowers your modified adjusted gross income limitation. Remember that 500,000 we were talking about? Let's say you're on the cusp of 500,000 and you just paid 30 in, you just brought yourself down to 470. That's awesome. So you can kind of play the game of, I don't want to be at this income level. Let me make that big payment at the end of the year, get the federal tax deduction, show less than modified adjusted gross income, and then claim that credit back on your 1040. It's the trifecta state tax strategy when it comes to state tax planning. All right, I'm done. I'm out of breath.
Sound like Houdini. Sound like you pulled a move on there. Almost sounds like the HSA. 3 benefits.
It's triple threat.
But again, I don't want to be glass half empty type guy. But let's think about this before we make a massive pass-through entity deduction. First, you got to have the cash on hand for it. But I will say what I do love is that you're using business monies for this payment, and you're getting benefit at the business level and at the individual level twice.
Bingo.
So that's pretty cool. Yeah, we love this. We talk to our clients on this all the time. But again, we're talking to income tax states. And it's also important to note, there are some income tax states, but only for individuals. And the state might tax a business. Even in an income tax-free state, it might still tax business income.
Right.
So that's another wrench to throw in the pile that you need to plan for. That's what you get in touch with Ledgerly, and we talk you through these things and help you maximize these deductions. Do we increase the withholdings? Do we make a PTE payment? All things to consider, but yes, we're definitely on board with the increase to the SALT cap.
Yeah, absolutely. And again, like, this might be music to everyone's ears watching this, but we do have to take a step back and face reality that, like Andrew said, everyone's situation is different. My situation is different than Andrew's, right? So, and we talk about that on a daily. There might be things that are going to benefit someone that's in my situation that I'm constantly thinking about. And Andrew might be like, oh yeah, it's a good idea. Or vice versa. Andrew might come up with something, a great strategy for a single individual. And I'm like, oh yeah, crap, that is a great idea. So again, everyone is different. Everyone's situation is different. But the most important thing is to make sure that you're not sitting on a nest egg of cash, sitting there, not working for you, especially if we implement those tax strategies that are going to help you save the money. Let's put the money to work after the fact, after those deductions and those credits and those savings. So yeah, I guess that's all I got on the SALT side of things.
We salted that one pretty good.
Yeah, it is salty.
Yeah, so
very salty.
Those are, again, what we deem to be probably some of the biggest 3. I mean, there's so much from Trump's bill, but the 3 biggest things that can help you on your tax bill this year, for you business owners, that 100% bonus depreciation, and then for individuals and businesses alike, the PTE tax with the SALT cap.
Yeah.
Really the SALT cap. Now, there's, like I said, so much that went into the Trump bill, and we couldn't possibly sit down here and dissect everything, but there's a lot of temporary provisions that came out. Like, he was banging on the campaign trail, no tax on tips, no tax on overtime. He was able to get that passed, but you need to know there are thresholds. There are limitations. Now, we work for ourselves. We don't pay overtime or receive tips. But if somebody made $30,000 in tips, that doesn't mean they're not getting taxed on they're going to get to deduct $30,000. I think the limit's like $15,000. Correct me if I'm wrong.
To 20, 25,000. But I think it's also important that it's only avoiding the federal and state income tax, not the dirty FICA, not the get the FICA out of here.
That was my next point.
You're still FICA-ing on that FICA money.
So there's still tax associated with it, but that income tax gets avoided. But again, if you make too much money, your deduction might get limited. And this is for both the tips, the overtime, the numbers change if you're filing jointly with a spouse.
Yep.
Other temporary provisions like the senior deduction. If you're over 65, I think the amount's $6,000 or $6,500.
Yep.
Again, other phase outs apply, but that's cool because it's on top of your standard or itemized deductions. It's not instead of, it's kind of a cherry on top.
Well, I guess one important thing on the temporary side that we didn't mention is that
the SALT cap.
Yeah. SALT is temporary. It could go away in 2029.
All we're talking to you is about what the tax code looks like today,
right,
with Trump's bill passing in July earlier this year. But right now, the SALT cap is set to go away after, I think it's after 2029.
Right.
It's set to revert back to that $10,000. But again, who knows what happens when the next president comes into office, or if more talks on new tax legislation pick up. Nothing is a given other than death and taxes.
Death and taxes.
Isn't there a third thing?
The
IRS, unfortunately, isn't going anywhere. But the SALT cap at $40,000 is here right now, but it won't be here forever.
You know, now you got me stumped on that third one. What is it?
That is a saying, right?
Birth, death, and taxes? I don't know.
Something, death and taxes.
Start a business, death and taxes. How about that? Be a business owner.
That'd be nice. But yeah, any other highlights from the big, beautiful bill?
I mean, you talked about it earlier, but I got it up now. Standard deduction increase. So for you single filers, $15,750 for 2025. Joint filers, $31,500. We talked about the SALT, tips, $25,000. The auto loan interest deduction.
Oh yeah, I think that's getting hyped up because there's so many rules around that.
Yeah, it has to be an American-made car. It has to be manufactured in the United States. It has to be a new car. It can't be a used car.
Yep. Loan has to have originated after January 1st of 2025.
Yep. Income thresholds obviously apply.
If you're a business owner and you need a car, let's find a way to write it off through the business.
Yep. One of my favorites was the Trump accounts that got introduced. So
you having a kid soon?
Oh, it's fertilization day. I'll be right back. That's some.
I'm just saying,
fun.
If you're planning on having a kid, you want some tax savings for it, you want to do it by 2028. That's all I'm saying.
Well, the other thing
not even tax savings. It's for generational wealth.
Generational wealth building. Yeah. So it's essentially, if you're having a child from 2025 to 2028, you're able to put away $5,000 for your child to grow tax-free for certain uses. And if they're born in that window, 25 to 28, the federal government is putting a $1,000 seed fund. They're going to fund it, open the account, and then every year, mom and dad, you can start putting away for each of your child up to $5,000. Now, if your child was born before 2025 or after 2028, you can still utilize these accounts until your child reaches the age of 18. The only downfall is that the federal government is not contributing that $1,000 seed contribution.
And what can they take those monies out for? College,
first-time home buyer,
medical.
Yeah, medical. It's essentially a Roth IRA. And then once they reach a certain age, probably have to go back to the drawing board on that and do a little bit more research. But they're going to be able to take the money out tax-free for any use. But again, it's a way. $5,000 a year over 18 years. I guess $5,000 plus the $1,000 seed contribution. It's a no-brainer.
Yeah. So if you're going back and forth with your spouse, should we have a kid? Should we not? Maybe bring this up in your next conversation and see how that levels the playing field.
Well, yeah, I think it costs a little bit more than $5,000 to have a kid, but yeah. Also, I guess the child tax credit increased too, right? Was that like 2,200 now?
Oh, yes, that's another big one. Again, for you families out there, you young families with kids under 18, you're claiming your dependents, your children. The child tax credit was set to go back to $1,000. Again, had this bill not passed, it was at $2,000. It was set to revert back to $1,000 because Trump initially brought this in with TCJA, and then part of the one big beautiful bill, it actually increased to 2,200 and it was made permanent.
Right.
So again, great for young families.
Yeah. What else? I mean, I think the only other thing I can think of that's glass half empty type thing is for all you green individuals that like the energy credits and all that fun stuff. That's going away. Like those are getting phased out.
And that is why Elon and Trump are no longer boys.
Button heads. I hope we never become that way. That'd be really sad.
I'd be sad too. That means a lot for you to say that in front of all of our friends.
Yeah, it's like I'm not gonna say it, but
so yeah, the green energy credits, a lot of them are going away or phasing out. I think starting as soon as September of 2025. So if you're that type of investor or you've been using those types of credits in the past, get on your P's and Q's, get those projects started because they're going to be gone at the end of the year, those credits. But there's still time to capture them before they go away. Other things, the estate tax exemption, that's another one of those things that was set to get cut in half, essentially, because Trump increased it, pretty much doubled it as part of the TCJA. It was sunsetting, going away this year, but he said, no, let's keep that, and why don't we make that permanent? Pretty sure that was a permanent change. So you wealthy families are those that are really focused on that generational wealth building. What this does for you, now instead of being able to pass on $15 million of your estate on tax-free to your beneficiaries, now it's more like 30 million.
Yep.
So obviously that's a massive increase.
Yeah, 30 million, and it's indexed for inflation every year as well. Yeah, what else? What else can we riff on here?
The QBI deduction. For you business owners, you're probably familiar with the QBI deduction. You get to take a federal tax deduction for 20% of your business income.
Yes.
That was something that was also going away. Trump said, nope, that's going to be here to stay. So it's back like it never left.
Yep, exactly. And that kind of goes back to what we were talking about with the bonus depreciation for those people in the industries that are maybe more service based that don't really need those deductions. Kind of the same thing. There's a thing called an SSTB. It's a service based business deduction where your income, if once you hit that certain threshold, that QBI deduction goes away for you because your overhead is low. You don't have as many deductions as a manufacturing business or a business that's manufacturing goods, selling goods, third-party goods, all that stuff, lower costs. So you're not graced with the 20% extra deduction if your income is over a certain deduction, like anything in this world. So that's a good point. Back like it never left.
And then one thing that just sparked that we should have mentioned earlier, run it back to bonus depreciation. We were talking about all the federal benefits for being able to deduct 100% of a big capital purchase in the first year. Know that that does not apply on the state side. For most states, they do not conform to the federal depreciation rules. A lot of states, like Connecticut, we're in Connecticut, will say, hey, that's great. I know you're writing off your $20,000 purchase using bonus. That's cool. You have to add that back on your state tax return. So yes, you get a $20,000 federal deduction, but on the state side, you only get, depends on bonus or, like we said before, Section 179 depreciation. You have to add back either, I think bonus, you have to add back all of it, and you can recapture it, take those deductions over the next 4 years at 25% a pop. So in my $20,000 example, you add it all back on the state return, but then in next year, year 2, you can deduct $5,000. In year 3, another $5,000. Up to year 5, you've written off $5,000 for 4 years. There's your deduction.
Right.
So it's, yes, bonus is great and it's fantastic, but there's things like you got to realize What industry am I in? Do I really need this asset? And hey, I'm going to get the federal benefit, but I'm not going to get the state benefit. But then you're going to go back to this. You're going to listen to Mike riff on the SALT cap and say, hey, why don't I just increase my state income withholdings and let's take advantage of that federal credit or that federal deduction and maybe help me out on my state taxes as well.
Yeah, that's such a great point. Look, dude, my head is like, we work in this industry and my head is spinning right now.
The
So
tax,
for the viewers at home, like, holy crap, like, thank you for watching if you're still here.
but and that just go off that. That is why you need a tax advisor. Listen, obviously, if you want the best, you come to us. But if you want anyone else, just get a tax advisor, a CPA, someone who's, I'm going to say, on the cutting edge, but is well informed with the current tax code. Don't go to the 70-year-old firm down the road just because, yeah, maybe nothing wrong with them. But are they going to stay up to date? Are they going to be proactive with planning? Or are they just going to do everything the same way they've done for the past 40, 50 years? I digest.
Yeah. I mean, if you smell that crispy sensation after the race, that ain't your tailpipe. Shake and bake. We're too far with the movie quotes. Yeah, very important. Please, please, please do yourself a favor, especially with Trump's new bill with all these awesome things that have come out. Love or hate the guy, this tax bill is great, especially for business owners and you individuals.
He's trying to help the American taxpayer.
Yep. Your standard deductions are going up while your tax brackets are staying the same. Those are going to stay, tax brackets were going to increase and your deductions were going to come down. So again, I digest. Just do yourself a favor. And if you want more money in your hardworking American pocket, like Andrew said, contact us. We're the best, I think. We do a good job. We're decent people.
Decent at best. But this is stuff we love talking about and helping our clients, again, save on those taxes. I want to help them build better asset protection because the ultimate goal of generational wealth, that's what Mike and I are after. And we help our clients do the same. So we hope you like this. Please leave your comments, questions, like this video, subscribe to this channel, get over to our Instagram, share it with friends, share it with family, share it with other business owners. We'd love to help you. We're constantly giving out free advice. At the end of the day, we're here for you. Thanks for tuning in.
Cheers, guys.